5 minutes after our start time, so I'm going to go ahead and ask that we get started, and I'm sure we're going to have more people joining us on the call. So welcome, everyone. Happy Friday, and we are here at WealthWise Financial Services to give you good information that can help you and your family with investing. Today's topic is about the municipal market. What happened? What's going on? What are the opportunities going forward? And with that, we are so pleased to have AB Funds here to support us with one of their portfolio managers that we use for municipal bonds on the line with us. We're very excited about this phone call. It's not easy to get the portfolio managers on the phone, so we're very happy to have them. We have a long-standing relationship with Dan Mellahan, who is our representative with AB. And Dan, I'm going to turn it over to you. We thank you so much for making this opportunity a reality here for us today. And so just some housekeeping is that, as Dan just mentioned, people will be put on mute, and then after Daryl's comments, we'll be able to ask him questions. I'll start that question and answer with some questions that I've been hearing from our clients, and then we'll allow other people to ask questions as well. And with that, Dan, I'm going to turn it over to you. Thank you so much.
Loreen, thank you very much for giving us the opportunity to be on the call today to talk with you and your clients. Just so everybody knows, on the line, we at AllianceBernstein manage a little over $30 billion in tax-free municipal bond assets. And as I was getting prepared for this call, I came to the realization that Loreen and I have been working together for over a decade. And as I was thinking about that, I came to the other realization that Father Time has been unbelievably unkind to me relative to Loreen, because I was looking in the mirror today and I see a lot of gray hair, and clearly he's been less kind to me than he has been to Loreen. As she mentioned, we manage a tremendous amount of tax-free municipal bonds. And quite candidly, if you didn't work with Loreen, you would never have the opportunity to interact with our guest speaker. We very rarely afford individual clients the opportunity to talk to our portfolio managers because they're very busy managing the portfolios, especially during this period of market volatility around munis. So you're in for a treat. The other thing is, in preparation, I made sure that everybody at AllianceBernstein knew, I'm like, hey, when you're on this call, you better bring your A game, because Loreen is on television all the time. I see her on CNBC. I see her on Fox Business. And so you really got to make sure you bring her A game, because her clients are used to seeing her on TV delivering a very, very high level of expertise. So without further ado, Daryl, if I didn't give too much pressure to you, the portfolio manager I have on the call today, his name is Daryl Clements. He's a portfolio manager on our municipal bond strategies. He joined us at AllianceBernstein in 2002 as a municipal credit research analyst, responsible for evaluating municipal issuers nationwide with a particular focus on transportation, public power, and tobacco bonds. In 2006, Daryl was named to the portfolio management team and received a promotion. He is on the tax-exempt fixed income investment policy group. Before joining the firm, he was with Financial Guarantee Insurance Company for 6 years, and then prior to that, he worked for Moody's Investor Services for 5 years. And then I always mention this in my introduction to him because I'm a huge fan of investing in airport bonds, and he's my idol because he co-authored an article that ended up being a chapter in the Handbook on Municipal Bonds, and it's the name of the chapter is How to Analyze Airport Revenue Bonds. So without further ado, I'm going to turn it over to Daryl Clements. He's going to give us an update on exactly what Loreen said, which is where we've been in the municipal bond market, where we are currently, and where we see opportunities and what our outlook is on a go-forward basis. So without further ado, Daryl Clements.
Thank you, Dan, and I hate when you talk about that chapter, but it is what it is. I cannot stop you. But what I will do, though, Dan, one thing you said, I think I heard you correctly. When you said we managed about $30 billion. Actually, we managed $50 billion, a little over 50. But what's a few tens of millions between friends? Or billions. between friends. That's okay. Now, with that said, what I will do, I will take some time here to cover what happened in the market, in the municipal market. There's been a lot that's been going on, clearly. Kind of take us up through I want to start from the beginning of the year through today, spend some time on what happened in March, because March was quite a volatile month. And then we'll kind of talk about where we see things going forward. All right. So, and then would love to take everyone's questions and comments. So a couple of things. When we started the year, just think about it. It seems so long ago, but when we started the year, through the first 9 weeks of the year, I would say through the first week of March, bonds were doing, or municipal bonds were doing, just what everyone thought they would do, what they typically do. They had positive returns in January and February. Through the first week of March, they were offsetting equity volatility. As remember, equities were down, especially in the month of February. So municipal bonds were there. They were acting as the bedrock of a client's overall asset allocation. So all was good up until the second week of March. And then the municipal market and other markets, quite frankly, ran into a buzzsaw. And the buzzsaw was the fear around the coronavirus and COVID-19. And what you began to see as those fears started to emerge, there was a fear around the market. And when the economy began to be shut down and fears of the economy being shut down, what you saw was an enormous amount of outflow in the municipal market. And when I say enormous, there was a number of records that were set in the municipal market during the month of March. Living through it, Dan talks about his gray hair. I didn't have any of this gray hair up until February or March. So it was a very volatile month. And what we had was $43 billion left the municipal mutual fund world around the market. Prior to that, the record of outflows, mutual fund outflows, was $16.5 billion in June of 2013. So you can see the fear that captured the municipal market and causing those outflows during the month of March. And what does that trigger? Right? Now that triggers bond managers having to sell bonds to meet those redemptions. So what we began to see was an enormous amount of what we would call secondary market supply going out to find bidders on bonds. So for example, on a normal day in the municipal market, there's roughly 3,500 bonds that are out, what we would say, for the bid, looking for somebody to bid on those bonds. During the 2 middle weeks of March, between March 9th and March 23rd, there were days where we had 12,000 bonds looking for a bid. So when you have that many bonds out for a bid or looking for a home, but you have a lot of outflow, so you have a lot of supply, not a lot of demand, what will happen is prices will fall and yields will rise. Okay, so they're looking for a home, right? They're looking for a floor. So yields kept rising and rising and rising. And I'll give you, if you have a pen and paper, you can write this down, and we can share some slides with you. But But if you were to write some of these numbers down, to begin the year, I want to show you the magnitude. Give you and use a baseline as a 10-year AAA municipal yield. Started the year at 1.44%. Okay, 1.44. By the end of February, that yield had reached about 0.95. So bonds rallied, meaning yields were falling, prices were going up. By March 9th, that yield had reached 0.78. So continued to go down through the first week of the year. Then by March 23rd, that yield reached 2.79. So what that happened was, when people were exiting, yields were kept going higher and higher and higher until a buyer was to be found. And what typically happens in the municipal market over the last decade or so, we would call it crossover buyers would step into the municipal market. Those buyers who typically buy taxable bonds, say corporate bonds or U.S. Treasuries, but then cross over into the tax-exempt market to buy tax-exempt bonds when they become really, really attractive, really cheap, if you will, relative to what else they could buy on the taxable side. So you started to see that right around March 23rd. So it started to provide some stability in the municipal market. And think of those buyers as your insurance companies or banks. And even our other side of our fixed income shop, where we manage $50 billion, we have a taxable side that manages $250 billion. They started to buy tax-exempt bonds. They were asking us to buy them. And so that was good news. Then the traditional municipal money, typical muni buyers, started to step back in. But then what gave the market an enormous amount of comfort was when the Federal Reserve turned around, basically, I'm going to paraphrase here, and said, don't worry, we can buy municipal bonds if need be through our mutual money market facilities corp. And that gave the market so much confidence that there was an ultimate liquidity provider, if you will, that the yield that I gave you that was at 2.79 on March 23rd fell to 1.26 just 4 days later by March 27th. So I swear we saw 2 years worth of volatility in the municipal market in 3 weeks. So there was an enormous uptick in yield, and then yields came right back down. And where we are today with yields, and we'll see where the market ends today, and I'm just kind of taking a look here, where yields are. Yields today will end at would be at about 125 on that 10-year at the end of today. So yields kind of have been a little volatile since March 27th, but they've hung in there. So actually, for the year, high-grade bonds have positive returns for the year, meaning AA and AAA rated bonds are positive, even though there's been an enormous amount of volatility around that. And what hasn't changed all that much. So remember, for those of you who are not familiar with bonds, ratings, if you will, you have AAA, AA, single A, triple B. Those ratings are investment grade, and anything below that, double B on down, single B, triple C, double C, all the way down to D or default, that's non-investment grade, okay, or junk bonds, high yield, if you will. Now, when yields rose during that 2 week period of time, it rose for all bonds, even Treasury bonds. Actually, yields were rising during that period. So, and then I say that I told you that yields came back down, but that was for high grades. They haven't moved all that much or nearly as much for single A rated bonds or triple B rated bonds, which are mid-grade investment grade bonds. And they haven't moved for high yield that much either. Now, question is why? Why did high grade bonds move, but high or mid-grade and high yield did not? They haven't snapped back, if you will. Part of that is because the early parts of during the month of March, I would define as a month of illiquidity. Now there's different concerns because the Fed has taken that illiquidity fear off the table, saying that they can buy bonds. So people are kind of fine with that now. But now going forward, there's questions around the fiscal health of municipalities. And in California today, you would have seen, right, or yesterday, that the state is now starting to come out with their budget numbers. And next week, the governor will come out with what's known as the May revision. By law, by statute, they have to have it out by May 14th. So sometime next week, there'll be an official announcement by the governor. So now there's a fear around the financial health of not only states, but also municipalities and localities throughout the country, because revenues have gotten hit as we have over the last number of weeks. I will kind of tongue-in-cheek say that we've placed our economy in a medically induced coma and looking to bring that economy out of that coma over time. So what I also want you to know that when any recession that we're in, and clearly we are in a recession today, that the first taxes to be impacted will be your income and then your sales tax, because they are the most economically sensitive. And that's why states will always, always feel the brunt of an economic downturn initially. They always do, because they're the ones who collect those taxes by and large. Local municipalities, your cities, your counties, your school districts, primarily collect property taxes. Property taxes are not impacted early on in a recession because they're based off of property assessments. So for me, I am a New York resident, New York City resident. I pay my property taxes to New York City. I received my assessment in January. My property taxes in New York City are locked in for the next 12 months. So what that means to you is that local municipalities, their property tax or revenue source is much more stable early on in an economic downturn or recession. So it's usually 12 to 18 months out when, if your assessment is reassessed down, that's when property taxes would fall or revenues would fall. Now, why that's important? Because where states don't have a lot of time to react, local municipalities do. They have a long runway here of 12 to 18 months to get their budgets in order before they really feel the impact. So something to keep in mind. So to get back to California real quickly, I want to warn everyone on this phone call that you are going to read over the coming weeks some really bad headlines. I've been warning folks about this for a number of weeks now because we are smack dab in the middle of budget season. And so when we look at California, and they're projecting through the end of this fiscal year, which ends June 30th, and the beginning of the next fiscal year, July 1, roughly a $53 billion deficit, if you will. Now, that's a big number, and that's on an annual budget of roughly $150 billion. So the question you have to ask, right, you should ask, how do they cover it? And what we have to answer is give you that, right? How do they? Because remember, and I think this is important to work our way through this framework real quickly, how we're thinking about this. Because it's not a one-dimensional problem, right? It's not revenues are down, the state is screwed, excuse my language. That's not it, right? Revenues are down, what are the options to cover this? What is the liquidity? So let me give you an example. The state has roughly, depending on how you calculate it, roughly, let's call it $19 billion in reserve funds. They also have the ability to borrow through other funds throughout the state. They don't only manage their general fund, but they have a lot of other funds. They could borrow another $38 billion from those. So 38, 19, so we got $57 billion. Then they also have the ability, and I want to make sure that I can't overstate it enough. My next comment is the Federal Reserve a few weeks ago opened up what is called the Municipal Liquidity Facility, where states and certain larger municipalities, but for the smaller municipalities, the state can borrow for them. They can borrow from the Federal Reserve upwards of $500 billion. That is an enormous amount of liquidity that basically takes any liquidity issue off the table for any state municipality for well over the next year, okay, to provide a bridge to the other side of this crisis. California can borrow upwards of $39 billion from that. So not only that, they've also received upwards of $15 billion in stimulus monies and FEMA reimbursements, as well as another $9 billion in Medicaid, increased Medicaid aid from the federal government, totaling about $120 billion in total liquidity that they have at their availability to cover this $53 billion shortfall. California will be fine. The numbers will be ugly. There's going to be a lot of back and forth between the state governments and the federal governments. But that's the nature of municipal bonds, and that's the nature of politics. The states want more money. The federal government may not want to give them, so we're going to have that haggling back and forth. And once you run that framework across all 50 states and down through your localities, what we've come to the conclusion is that this environment is not one of broad-based bondholder impairment or default, not by any stretch. Will you see downgrades by rating agencies? Absolutely. 1 or 2 notch downgrades? Yes, you will. But everyone, again, on this phone call should know that ratings are lagging indicators, meaning the market will always reprice bonds before the rating agencies act. Let me give you an example. So California, state general obligation bonds, before the crisis, were pricing, if I were to look at an average AAA rated yield in the market back at the beginning of the year, let's say a 10-year, I gave you that example of 1.44, California yields would have been 10 basis points less than that, or about 1.34, okay? Today, about, let's say about 3 weeks ago, that spread, if you will, it was minus 10, as I just explained. It got as high as plus 60, and now it's plus 30, meaning above a AAA. So the market has already priced in that California is now no longer worthy, so to speak, of a minus 10 spread, that they're better than a AAA. Now they're telling us that California yield should be higher, more in that AA or low AA. So the market's already taking care of it for us, and rating agencies will lag if they do move. Now, what does that mean for us? What does that mean for you? What does that mean for all of us, quite frankly? Because the headlines are going to tell us one thing, but once you do the analytics, you may come to a different conclusion, and what that tells you is that there are opportunities out there. There are opportunities to take advantage of mispricings, if you will, in the market. And as the economy slowly awakens from its slumber over time, this is not going to be a rapid turnaround, but over the next 12 months or so, what will happen are bonds that have higher yields to them because of the economic environment we're in, those yields will steadily come back down, and those bonds will gain in value. Because remember, there's an inverse relationship. As yields fall, the value of a bond will go up. Now, some of those opportunities are, as I mentioned, you can buy state of California bonds at a plus 30 spread, meaning you can earn 30 more basis points in yield. That's great. I can buy other bonds, Texas permanent school fund bonds that are AAA rated. I can buy those at 50 basis points above a AAA yield. That using that 10-year AAA as a spread. Or I can buy, how about this? I think we can go out and buy airport bonds. Now, Dan said he likes airports. I like airports. I'm a little biased there because I did write that chapter in a book. But there are opportunities there, and you may scratch your head with that and say, Darryl, why would you buy an airport bond when airlines aren't really flying? A lot of people aren't flying anymore. And there's a couple of reasons for that. And I'll give real quickly, although I do want to be mindful of everyone's time here. And once you get me on a soapbox, it's hard to get me off. You can ask my wife, tell my wife that. She knows. But anyway, a couple of things. One, I would tell you this, is airports by and large are cash hoarders, okay? So most large hub airports have 400 plus days cash on hand. So let me give you an example. SFO, San Francisco, has about 350 days of cash on hand. LAX has over 500 days cash on hand. San Diego Airport, over 700 days cash on hand, meaning they have a lot of internal liquidity. And they don't rely on the state of California. It doesn't matter what their financial position is. They have their own internal cash flow or cash that they hoard. And that goes a long way during these downturns because they can meet debt service and operations for well over a year based on cash that they have. And not to mention, in the stimulus package from the federal government, airports received about $10 billion. Do you know what airport debt service due this year amounts to? Less than $8 billion. So they received more in aid than there's debt coming due. So we're comfortable there, and I can give you other stats, but we can just leave it there. And toll roads are the same. Toll roads are ones that are also notorious cash hoarders. And I'll give you some numbers here. And when I give you some numbers, you're probably going to be furious every time you pay a toll, because you're going to come to the conclusion that you're paying way too much. So if you live up in the San Francisco area, Bay Area Toll Authority, they have 2,000 days of cash on hand. 2,000 days, that's wonderful. Let's go back to, like, let's say the South Bay Expressway, not as much for them. They have about 131 days. But what about your San Joaquin Hills in the Irvine area? 3,600 days of cash on hand. Your 91, if for your 91 Express Lane fans that you may take, they have 4,600 days of cash on hand. So every time you swipe your card or whatever you do, your pass, your Easy Pass there, think of the number of days cash on hand. But the point is that there's an enormous amount of liquidity built up into these systems. So even with traffic down, airline traffic down, there's enough support here that gives us a lot of comfort. And in these bonds, when I talk about California, where you can pick up 30 basis points, or in a Texas AAA permanent school fund bond, 50 basis points, we can pick up over 100 basis points or 1% more in certain airport bonds, and certain toll roads, 150 basis points or 1.5% above a AAA. And that's because they're misunderstood. And to a large degree, it was baby out with the bathwater during the month of March and somewhat into April as well. So with that said, I'll finish with this. As we go forward, we do believe the economy will slowly wake up, and we'll get people back to work. The economy will slowly improve. Credit spreads will narrow, yields will fall, and bonds will gain in value over time. This is not a broad-based default environment here, but there will be rating downgrades, no doubt in my mind. But that will, again, ratings are lagging indicators. So to us, there are opportunities out there, but what we always want to do as a bond manager, especially in our core intermediate bond portfolios, it's three tenets to which we manage to. Loreen knows this, and that is to provide income, which that's what bonds do. We all know that. But more importantly, preserve capital and dampen volatility in portfolios. So we will try to take advantage, but never to the extent where we're undermining the integrity of our portfolios and what we're looking to achieve. So with that, Loreen, I am going to, I'll be quiet now, and I would love to hear your thoughts, questions, and the audience.
Thank you, Daryl. So let's start with kind of the last point that you were just making. We use municipal bonds as a way for some conservative money. But year to date, it hasn't felt conservative. So can you please stress for our investors who, have this desire to have some of their money in a conservative allocation, and we're using, we consider municipal bonds income with capital preservation, just like you said, and yet it hasn't felt like that. Can you give some reassurances to investors about the municipal bond market, specifically when it comes to the idea of capital preservation?
Yeah. It's interesting, Loreen, we do run through this it seems every 3 years or so, we run through a very volatile period in the municipal market, whether it was 2016 around the presidential election, 2013 during the taper tantrum, 2010, if those of you remember Meredith Whitney, and then 2008 during the Great Recession. And if I were to tell you that, and this may be a shocking number to you, but if I were to look back and look at a municipal index, okay, and let's say it's an index of 4-year duration, shorter duration, AA average credit quality, so very, very bulletproof. If I were to tell you that over the past 30 years, if I look at the monthly returns of that index, roughly 31% of the monthly returns have been negative. 31%, a third of the time in a very high-grade, short-duration index, monthly returns are negative. That to me, that's a shocking number. But if you look over a 1-year period, the frequency of a negative return over that period is 4%, and over a 2-year period, the frequency of a negative return is 0. It's never happened. Doesn't mean it cannot happen. It just hasn't happened. And why is that? So the municipal market can be volatile because the investor base it's the retail investor base, and many investors, especially mutual fund investors, can get a little nervous by headlines and jump very quickly. And so for that, you can see that volatility. But over time, bonds heal themselves. They do play their role. But there can be intervening periods where you see that little shock to the system. So what I would say to folks on the phone today, that will bonds reclaim their role as the bedrock of an overall asset allocation and an offset to equities? Absolutely, they will. But however, over the next few weeks, as I mentioned, there will be some negative headlines, and that may cause some good days and bad days. This week was a very good week in bonds, as the market has calmed down and flows have regained and resumed, and except for high yield, but flows have been positive into the muni market. So they will regain, but know that this is not uncommon where we can have these weeks months where there is some volatility.
Great. So the next thing is, I know you manage both the mutual fund part of this as well as the separately managed account. And we encourage the municipal bond side to use the separately managed account, the SMA. Can you speak to that in your mindset and some of the differences there for investors?
Well, when you compare, a couple of things there, and I always try to put it this way, there's pros and pros for both, right? There's not really a pro and a con. I mean, so for example, now some of this is somewhat emotional depending on the investor, right? So one investor may have the mindset of, if the proverbial hits the fan, I want to pull the ejection lever and get out right away. And so they like mutual funds for that because they're out in a day. Other investors, if the proverbial hits the fan, I'm just going to hold on to my individual bonds to maturity, and as long as they don't default, I'm good. It's money good. So there are different emotional kind of aspects of this. Now, when I think about an individually managed bond portfolio, what I like about that is you can be more customizable, right? So we can customize a bond portfolio to a client's specific tax bracket. That's important, so because not every bond investor is in the top marginal bracket. Most are, but there may be some in the mid and low bracket, meaning they have a lot of assets, just not a lot of income. Perhaps they're retired, right? So we can be more customizable. In a fund, you cannot. A fund is always managed as one big top tax bracket account, if you will. So there's less flexibility there. There's also a bit more flexibility within an individually managed bond portfolio to, again, back to a tax perspective, take tax losses or gains if need be, very tactically. So in this environment where there may be some losses in a bond portfolio, everyone out there should be calling you saying, Loreen, can we take these? Can we take some of these losses because they are real and measurable to that particular investor? Because if you can take that loss, offset a gain, and avoid taxes, which we all would love to do, avoid taxes, and then take the proceeds and reinvest in a higher yield, which was the reason for your bond losing value to begin with, you will come out with a higher return. You can do that more effectively in a separately managed account. You can do it in a fund. You'll have to sell shares of the fund off. And what we will do within the fund anyway is we will take gains and losses within the fund, but fund losses within cannot be distributed. You distribute gains in a fund, but house the losses. So you don't necessarily get the direct benefit from that. So there are positives to both sides of it. Funds have an enormous amount of liquidity, as I pointed out, pull the ejection lever if you want to get out right away, and there's an enormous amount of diversification. But you can get sufficient liquidity and diversification within an SMA as well.
Okay, so let's address the Fed. And then another question. You talked about the Fed and everything that the Fed is doing in essence providing liquidity for the municipal bond market. But then you heard Mitch McConnell make the statement that he made about, look, we're not going to come rescue states and municipalities that have not been, taking care of business. And you've heard other people talk about that. Can you talk about these two sides of the Fed and Congress and what you see there?
You know, it's interesting. We've been telling folks for a long time, for many weeks, to be prepared for these bad headlines. And thank you, Mitch McConnell, for jumping right in there and kind of proving my point. And what Mitch McConnell did, and you know, he reacted viscerally to one state, and he reacted to the state of Illinois. Because if you go back, Don Harmon, who is the state Senate president in Illinois, wrote Congress-elect asking for more assistance. Within that letter, he also asked for $10 billion to fund their woefully underfunded pension fund. So Mitch McConnell reacted to that, basically saying, we are not here to bail out your underfunded pension fund. Illinois made conscious decisions over the last 20 years that put them in the position where they are today. And it's not fair that other taxpayers around the country bail them out, which I completely agree with. So he reacted to that, and he threw bankruptcy out there, saying that we would rather allow the states file for bankruptcy, which, by the way, they're not permitted to file for bankruptcy. There'd be a myriad of constitutional issues to overcome, 10th Amendment rights, contract clause rights. The state can't write a law to exit their own contracts, right? So there would be a lot of issues here. So where we stand here is there is seemingly bipartisan support for additional aid to states and their localities. The question is, what's the number, right? Because states are looking for roughly $500 billion. I've seen numbers from $500 billion to $1 trillion for states and localities. But that's backfilling every lost dollar of tax revenue, which you cannot expect the federal government to do, right? The federal government is going to expect California and others to use their reserves, to make some cuts, to do certain things to help with that. So there's a bipartisan support for that. But there's I would say this, the Republicans are trying to avoid, the Mitch McConnells, and President Trump has talked about this as well, and I agree with this. They want to make sure that money doesn't flow into these pension funds, right? But that's hard to do. That's very difficult to do. So what I would expect that something happens over the next 30 days or so is that there's going to be an agreement, and Mitch McConnell is going to say something like, okay, you cannot use these funds to go into your pension funds. The states will say, okay, but there's no way to track it. And both sides get a political win. So there will be more state aid coming. The last stimulus package, the CARES Act, provided upwards of already $150 billion for for assistance to states and localities. But that was directed for expenses. Now, that hasn't nearly been utilized, that $150 billion at all, not even close. So what I think is going to happen there as well is that the Treasury, U.S. Treasury, will redefine it and be allowed to use that money towards offsetting revenue losses as well. So more to come on that. So there's still a lot of support here from the federal government and an enormous amount of support from the Federal Reserve through the ability for them to provide or buy municipal bonds either through the money market liquidity facility or the municipal liquidity facility. That is enormous. Now, they haven't done it yet. They haven't had the need to. The money market facility corp, they haven't had to buy there in the first degree. The second degree with the municipal liquidity facility, that $500 billion in short-term support, no one has tapped into that yet. But it's just knowing it's there is providing an enormous amount of comfort. And again, I cannot stress enough to everyone that $500 billion is tremendous support, an enormous amount of support. And there's more to come. They're talking about buying ETFs to provide liquidity as well. So they're thinking about other things if need be. So stay tuned. Stay tuned.
And how exactly would that work? Because the Fed hasn't done this before on, let's say this idea of actual purchases. How would that work?
That's a great question because it hasn't been done before. And the reason it hasn't been done before is that there's political overtones there. And so the Fed has always wanted to step away from getting involved in politics, which I don't blame them. None of us want to get in the middle of that battle. So how it works is not exactly clear. Now, I will tell you, for the municipal liquidity facility, the $500 billion program, what would have to happen, the mechanics behind that would be the state, let's say state of California, they go out to the market for what's known as a cash flow note, short-term financing. And they either cannot get a bid, meaning they have no market access, or the yield that they would have to pay is way too high. The penalty, so to speak, is way too high. Then they would go to the Federal Reserve and say, we tried to access the market. We either can't or the costs are too high. Then what the Federal Reserve would do is say, okay, we will buy your notes from you at a agreed upon rate. We don't know the mechanics there yet. That's probably not going to be available until the 15th. So we'll know that those mechanics. But
yeah.
And then the state would, the Fed would take them, and then over up to a 3-year period, the state of California would have to repay the Fed.
Okay. So, like you mentioned a moment ago, there are these periods of time where there's volatility in municipal bonds, and then people get nervous about that. And you talked about, look, California's okay, there's going to be downgrades, but, it's going to be fine. Can you dig into that a little bit more? Because I know our investors, at times like this, get nervous about all the headlines that they're seeing out there. And I'd like you to also talk about the opportunity going forward, because the way we view the world is that when we come out of this, taxes are going to go up. We're going to have to pay more in taxes for all of this money that's being spent. That would make municipal bonds even more attractive. Can you talk a little bit about that?
A couple of things here with your comments, Loreen. It's not a coincidence that no state has defaulted since the Great Depression. And for the trivia fans out there, the state of Arkansas defaulted during the Great Depression, but they made their bondholders, paid them back in full within 2 years with back interest. It's not a coincidence that the long-term municipal default rate is 0.1%, nor is it a coincidence that through the Great Recession, 2008, 9, and 10, that the municipal default rate did not go above 0.1% during that period. It talks to the resiliency of states and their municipalities, right? And it never gets talked about. You don't read about it in the papers, but it is there. Will we see defaults? I'm sure we will. Of course we will. You have seen them in California, San Bernardino, Stockton, Vallejo. They don't happen right away within a financial crisis. It takes a few years before it compounds. So these are things we can see coming down the road. Municipals are not a corporation, right, where a corporation can dry up and go away, right, and it can hit hard quickly. Municipals, you tend to have a very long runway. You can see the issues building because, remember, the ability of a state and municipalities to a lesser degree to raise taxes, cut expenses, and as you say, are we going to see more taxes? Oh, yes, we are. We are. The state of New Jersey is already talking about the trifecta of raising sales, income, and their gas tax to pay for this. The city of Nashville, Tennessee, also talking about raising taxes to pay for this. So it will begin. And then the question is, what about at the federal level to pay for this? So in our mind, and I agree with you, your line of thought, I think, is spot on here. The municipalities will get through this. There will be some defaults, I'm sure, but there's over 60,000 municipalities in this country. So, but you will have your default here and there, no doubt about it. We have done a very good job of avoiding those because of our credit team reviewing every bond in our portfolio. So we're very comfortable where we are. And then as taxes go up, they inevitably will over time. What's going to happen is municipal bonds become even more attractive because it's even more valuable to kind of shelter your income from those higher taxes. So there will be inevitably more demand for municipal bonds as a result of higher taxes. So when you think about it, when we talk about that there's a lot of opportunity because of mispricings, misunderstanding, fear out there, and then couple that with over time taxes going up, there's I would say a sizable amount of opportunity. I don't want to say significant, but it can be. Last year we had returns around 8% in municipal bonds, and coming out of this period, let's say over the next 12 months, the math behind that getting back to an 8% return. Loreen, you know the math behind these things. It doesn't take a lot given where we are right now. As long as the economy cooperates and people start gaining confidence and come back into the market as they are, we're starting to see that, it should bonds will do okay.
So thank you so much. My final question, and then we'll ask if there are any others. My final question is around the importance of research and explain how the municipal bond market has changed, because we have investors who used to go to advisors and buy individual bonds. Can you explain how that's changed? And that explains why people like me are using portfolio managers like you in the separately managed account arena to do that work. So can you explain that to people?
Of course, and that's a great question, great point, because you know an enormous amount about bonds. You know the industry, you know how to buy bonds, you know you can go out there and build a bond portfolio, right, under normal circumstances. And if I were to take you back and your audience back to 2008, right, the financial crisis, a lot has changed because of the financial crisis. The municipal market has, I would argue, I've been in this market now for about 30 years, and we will never, ever go back to the way the market was pre-2008 for a couple of reasons. Number one, prior to 2008, there was something known as municipal bond insurance. And about 60% of the new issue market was insured by AAA rated bond insurers prior to 2008. Now, what does that mean? Well, that means if you had an insurance policy on your bond, if California bought an insurance policy for their bonds that they issued, well, if they were to default on their debt, the bond insurer would pay timely payment of principal and interest. So there was never any risk with bonds, right? A credit risk from bonds. And by the way, if you go back to the early 1980s, so the early 1980s all the way up through 2008, what were yields doing? They were falling for the most part, right? Now, also during that period of time, you also had bond insurance protecting you on the downside of a credit event. So where was the risk in a bond? There wasn't. Yields were falling and you had no credit risk. That's where the buy and hold manager or the buy and hold investor was created over that period of time, because I didn't need to do anything but hold it, because I had no risk, yields are falling, I make a lot of money, all is good. But then bond insurers got greedy and they began to insure subprime mortgages. And when the financial crisis hit and the housing crisis hit, many bond insurers went out of business. They either went bankrupt, lost their AAA rating, so now they're underwriting about 5% instead of 60%, okay? So now there's big credit issues. Now that probably adds a level of complexity for you, your team, and others, because now you would have to go and do the credit research. And that's very, very difficult to do unless you have a credit analyst working on your team. The other issue that coming out of 2008 is how investment banks can utilize their capital. So what investment banks used to do, which was wonderful, they would house municipal bonds on their balance sheet as inventory. So you as an advisor and building a bond portfolio pre-2008, you go on your computer, you go into your system, look at your liquidity, you all thousands of bonds that you have to choose from to build your clients' accounts. After 2008, with various federal regulations that prevented how banks could utilize their Tier 1 capital or directed how they can use it, well, their inventory levels came way down. So now for you to go out and look at your inventory, there's not nearly as much that what you used to have. I don't have an inventory of bonds. I don't want an inventory of bonds. What I want is the entire market. So I have the ability that you do not to go out into the entire market, see every bond out there, get the best bond for the best possible price for all of our clients. And whatever price I get the bond for, whatever that may be, is the price our clients get the bond for. My trading desk is not a profit center at all. Whatever they buy it, I take it and drop it into my clients' portfolios. So that's the differences. So for you who know an enormous amount of about the municipal bond market, it's just not, it's just the market has changed. You cannot do, unfortunately, what you used to do very, very well and could still do if the market cooperated.
Yeah, thank you for that. I think that answers a lot of questions for people. And then, so Dan, we were going to have people unmute themselves to ask a question. I believe you said it was star 6. Is that right?
Loreen, you're absolutely right. Anyone who would like to ask a question, please hit star 6 on your phone, and you will become unmuted, and you'll be able to ask a question. And if you're thinking about asking a question, there are at least 5 other people thinking of the same question. They're just too nervous to ask, but we would love to have the questions.
We cover ground here, but let's come in and see if you have any questions. And of course, we are team here to answer questions following this call and make sure that you get those questions answered as well. So if you don't want to ask this call, we certainly can get those questions answered later. So let's see, is there anybody who would like to ask a question? We'll wait one more moment.
Hey, while we accumulate that, Daryl, can I ask a question real quick? Given that there's opportunity now in the municipal bond market, quite often we see people say, okay, I want to capitalize on that. If you were a retail investor and you wanted to capitalize on the weakness we've seen in the municipal bond market, how would you talk with them, or how would you as an individual investor do that?
To take advantage of the, so hold on a second. Let me make sure I understand your question there. So how does an individual investor take advantage of this current?
Right. I know you used the example of cannonball into the municipal bond market versus wade into the municipal bond market.
Yeah.
So I want to help manage people's expectations and give them the most judicious way possible that they could enter the bond market, knowing that there's been weakness over the last, say, 6 weeks to 2 months.
Okay, got it. So you're right. I have used that term, cannonballing into the pool or not cannonballing into the pool at this point, because I do believe that yields may go up a little bit from here, or even credit spreads, the difference between a single A, as I was pointing out before, and say a triple A may get wider, because now I was wrong this week. Yields came down, so it's really, really difficult to predict these things. But what I do believe that will happen over time, over the next few weeks, because of headlines that may occur, the negative headlines, as well as the fact, a very technical reason here, is that I can see, it's called a visible supply. What is the visible supply over the next 30 days for municipal bonds? So what issuers have bonds ready to go into the market, and it's totaling about $25 billion. And so municipalities have been holding back. They're issuing bonds, but not as much as they could. So what I think could happen is that over time, over the next few weeks, some of that debt comes into the market, and I think that could cause spreads to rise or widen a little bit over the next few weeks. So, but I could be wrong. I've been wrong this week as yields have come in. So the point being there, Dan, is, if somebody has $1 to spend, would I put $1 in right now? No, I wouldn't, because there is still some uncertainty. And when you have a lack of clarity, you want to be cautious, right? So you want to say, okay, I'll take that $1 and maybe 25 cents of it goes in today. And then I'm going to kind of reassess a couple of weeks later, 3 weeks later, let's see where the market is, and then perhaps another 25, 20, 50, depending on what's going on. If, again, more clarity, then you have more certainty, then you can put more of that money to work. So I think it's in this environment, it's a wading into the pool kind of scenario rather than a cannonball in because there is that lack of clarity.
Right. Along with that, though, when we're using the SMA, the separately managed account, we have those minimums that we have to meet, and then they don't go in all on one day. They have to purchase those bonds, and they're looking for those opportunities. So I just want to make that clear to people as well, because we've been doing it for a while to make those investments when we're putting new money into the SMA.
Yeah, and no, that's a great point. Is that we're not going to invest the portfolio within a day. It takes a number of weeks to do that. And we could also, Loreen, work with you and your clients if they were coming in at below minimum but expected to get to the minimum within, whatever it is, 1, 2, 3, 4 months, 6 months, and we can say, hey, Loreen, you're a great partner of ours, then yes, we can make exceptions for your clients along the way.
Wonderful. Okay, great. Dan, any closing thoughts on your end?
So my closing thoughts are just to kind of summarize a little bit of what Daryl said, is that this COVID-19 downturn that we've seen has been the most dramatic downturn we have seen ever. It completely can take your breath away, not only on the stock side, but on the bond side. Now, if you look going forward, to be very candid, we at AllianceBernstein, and Daryl in particular, we need these periods of volatility to create opportunities for us to find dislocations in the bond market. And when we find those dislocations, we're able to find great bonds at excellent prices that will deliver consistently better yields for investors over a long period of time. The challenge is it just doesn't feel good when you go through those periods of volatility. But candidly, in order to deliver the investment results that we've historically been able to deliver over the last 10, 15, and 20 years, we need this upsetting volatility because other investors will panic, they'll throw the baby out with the bathwater, and it'll give us a really great opportunity to pick up very great bonds at reasonable prices and above average yields. The one last thing I would say is AllianceBernstein and the way Daryl manages munis may be appropriate for all of you on the phone. It may not be appropriate. And I think that's exactly why Loreen gets paid the big bucks, as well as all of her teammates. She will match your time frame, your risk tolerance, your income objectives with your goals. And then she works with me and Daryl and AllianceBernstein and at least another dozen fantastic managers in order to match those managers' expertise with the needs of her clients. So I know you're in unbelievably capable hands. And with that, I'll turn it over to you, Loreen, in case you have any additional comments.
Thank you so much. I want to thank Daryl for being on this call today. Thank you for your time and your expertise. Thank you, Dan, for coordinating all of this. And I want to thank my team on the line as well, Annie Nagabi, John Milligan, April Martinez, all of you as well. We are here to serve you. We are here to help our clients, you, your family members, your friends, the people you know that need great advice. We are here to help them as well. So thank you for keeping us in mind. We're here to educate you. Our next call is going to be on Monday at 4 p.m. Pacific time about casting your vision. So if you haven't RSVP'd yet to that, for those of you who are clients, you know that is the first component of the three things that we talk about that we do when we talk about wealth management redefined. We help you articulate your vision, navigate the risks, and create a legacy. So we're going to be talking about that idea of creating a vision on Monday. We hope that you can join us on that call. Thank you very much, and please call us with any questions. Have a great weekend.